The IRS loves dividend investors, and that should terrify you. Let me paint you a picture. Two investors, same age, same income, same starting point. One builds a dividend-focused portfolio targeting around a 4% yield. The other simply buys a broad market index fund and never looks back. After 5 years, the dividend investor looks like the winner. Real cash is hitting the account every few months. The index investor has no cash flow but a growing balance. On social media, the dividend guy gets all the likes. But surface appearances and actual wealth are two very different things. Here is the first thing most dividend content online completely ignores. When a company pays you a dividend, its stock price drops by almost exactly that same amount on the ex-dividend date. A stock sitting at $100 that pays out $2 opens the following session near 98. You received $2, but your position lost $2. You did not create new wealth. You essentially forced a partial liquidation of your own investment. Academic finance has recognized this concept for decades. It is called dividend irrelevance, and yet the investing community largely pretends it does not exist. But here is where it gets genuinely painful. Taxes. Every dividend payment you receive is a taxable event, regardless of whether you spend it or reinvest it. Qualified dividends get taxed at roughly 15% for most investors. Non-qualified distributions, which include many real estate investment trusts and some foreign holdings, can be taxed at ordinary income rates reaching up to 37%. You are handing money to the IRS every single year just for holding those positions. That tax drag compounds against you silently over time. We are not talking about a minor inconvenience. Over a 30-year period, even a fraction of a percent in annual tax drag can destroy hundreds of thousands of dollars in potential wealth. The damage is invisible until it is too late to fix. Then there is something called the yield trap. It is seductive and dangerous. A stock flashing a juicy 8 or 10% dividend yield seems like found money, but unusually high yields often signal distress. Companies like AT&T and General Electric famously slashed their dividends in recent memory, and when a dividend gets cut, the stock price tends to follow it straight down. So you lose the income and suffer a capital loss simultaneously. That double hit is devastating, especially if that position represents a meaningful chunk of your portfolio. Dividend-heavy portfolios also tend to be structurally tilted toward sectors like utilities, financials, and consumer staples. These are slower growth areas of the economy. Meanwhile, technology and growth sectors, which have generated the overwhelming majority of market returns over the past 2 decades, rarely make the cut because they pay little to nothing in dividends. By chasing yield, you inadvertently exclude the highest performing parts of the market. So what does the math actually look like over 30 years? A dividend investor ending with roughly $1.4 million versus an index investor sitting on approximately $1.78 million. That gap is $380,000. The dividend investor never felt that loss because every statement looked green and the income kept flowing, but the opportunity cost was massive and entirely avoidable. And remember, the dividend investor also paid tens of thousands more in taxes over that same period compared to almost nothing for the index investor who held and let compound growth do its work. Now, you might push back and say, well, at retirement, I can live off dividends without ever selling a share while the index investor has to liquidate. That sounds logical, but it doesn't hold up under scrutiny. Both investors need income in retirement. The dividend investor receives distributions but pays taxes on all of them. The index investor sells a small portion each year and, by managing those sales strategically, can qualify for 0% long-term capital gains rates under current tax law. Same lifestyle, but the index investor still carries a significantly larger portfolio that continues growing. So are dividends inherently bad? Not exactly. Dividend-paying investments housed inside tax-advantaged accounts like a Roth IRA are a completely different conversation. Inside those sheltered structures, you eliminate the annual tax drag entirely, which changes the math considerably. The problem is not dividends themselves. The problem is chasing them in taxable accounts while sacrificing growth, diversification, and tax efficiency all at once. The real goal of investing is not generating the most cash flow. It is building the most total wealth. Shifting your focus from yield to total return is one of the most impactful mental switches you can make as an investor. Stop chasing the check, start building the number, because when you finally retire, it is the size of that portfolio that gives you true freedom, not how often money hit your account along the way.